There's a quiet tension a lot of disciplined investors carry, and you might know exactly what it feels like. You buy stocks, you think long term, you ignore the noise. And then crypto shows up loud, volatile, confusing. And suddenly everyone around you seems to be making money from something you don't fully understand. And you're just watching. That feeling isn't greed, it's not FOMO. It's the nagging sense that something big might be shifting, and you're not sure if your current strategy accounts for it. When you invest in stocks, you believe in ownership. You buy shares of real businesses, companies that produce revenue, cash flow, earnings, sometimes dividends. And because they produce those things, you can value them. You have a framework and analysis built over years. Crypto doesn't fit that model. Most cryptocurrencies don't produce cash flow. You can't plug them into a spreadsheet and get a proper valuation. Crypto's value comes from adoption, scarcity, and utility, things that are real but harder to quantify. So if you've spent years sharpening a valuation lens, crypto will always feel incomplete through it. And that discomfort is a sign that your discipline is working. But that discomfort has a downside. It makes most people dismiss crypto entirely. You already diversify across sectors, geographies, market caps. Not because you love every category, but because spreading exposure is how you manage uncertainty over time. Crypto is just another form of diversification, a different category entirely, not a replacement for stocks. And it helps to understand what you're actually buying. Bitcoin is the simplest to understand. Fixed supply, no central authority, designed to hold value over time. Think of it as digital gold. There will only ever be 21 million coins. Ever. Its value comes from scarcity and trust built over more than a decade. Ethereum is different. It's closer to digital infrastructure, a platform that financial applications, contracts, and systems are being built on top of. If Bitcoin is digital gold, Ethereum is closer to digital real estate. Two different assets, two different roles, but both represent exposure to something that didn't exist 20 years ago. Decentralized systems that are gradually changing how money moves. So, if Bitcoin becomes the digital equivalent of gold, would you want zero exposure to that? And if blockchain becomes a foundational layer of the financial system over the next 20 years, would you want zero exposure to the infrastructure powering it? You don't need to become a crypto believer to have crypto exposure. You don't need to follow the market daily, join communities, or have a strong opinion on every new development. For most long-term stock investors, thoughtful crypto exposure might just mean somewhere between 1 and 5% of the total portfolio. That's it. Small enough that if it goes to zero, life goes on. Large enough that if it multiplies over a decade, it actually moves the needle. That's not speculation. That's a small, measured bet with potentially significant upside. The biggest mistake people make when entering crypto isn't buying the wrong coin. It's abandoning their own framework. Going from patient, analytical, long-term thinking into reactive, trend-chasing, short-term trading. Crypto amplifies emotion in a way most assets don't. The swings are faster. The communities are louder. The shame of missing a run is real. The fear of a crash hits differently when you don't fully understand what you own. So if you decide to gain exposure, the discipline you've already built is your greatest protection. Treat it like a small, high-risk allocation. Your portfolio's core stays in stocks, in productive businesses. Crypto is a small part, not the whole strategy. You don't need to understand every technical detail of how blockchain works, but you should be able to answer a few basic questions. Why does Bitcoin have value? Why does Ethereum exist? What problem is each one actually trying to solve? If you can't explain that simply to a friend over dinner, don't allocate yet. Understanding what you own has always been worth more than rushing to own it. That's true for stocks. It's true for crypto too. Here's the irony. The investors who tend to benefit most from crypto over the long run aren't the loud ones. They're the boring ones. The ones who allocate modestly, ignore the noise, never use leverage, and don't chase whatever coin is trending this month. They buy it the way they buy index funds, quietly, patiently, and without drama. They let time and adoption do the heavy lifting, which is exactly how the best stock investors operate. And if you've spent years developing that kind of patience, you're already ahead of most people who enter the crypto space. You don't need to change who you are as an investor to add crypto. You just need to apply what you already know to a new category. The discipline that made you good at stocks, that's your edge in crypto too. Nobody needs crypto to build wealth. Stocks alone, held patiently, have always been enough. But the world is shifting. How money moves is changing. And the quiet tension you've been feeling is worth paying attention to. The same patience that makes you a good stock investor is exactly what most crypto investors need. If you already have the patience and the discipline of an investor, a small, measured position might not be reckless at all. It might just be the most rational thing a disciplined investor could do. If you already have the one quality most crypto investors will never develop, what's actually stopping you from investing in crypto? If this video helped you, consider subscribing. You can also like, comment, or share. See you in the next video.